Real estate finance, commercial lease transactions. First concept is the cost of rent. There's gross lease. That's where the tenant pays X dollars per month, flat amount, towards rent each month, quarter, or year. Next, there's a percentage of sales lease. That's where rent is some fixed amount plus some percentage of sales. As a landlord, you should contract for the greater of X or Y or X plus Y percentage of sales. Landlord advantage is that you're always going to get paid some rent, and you can sometimes get more rent if the tenant is performing well. The tenant advantage for this percentage of sales lease is that if you have good months, you can pay more in rent, but if you have bad months, you won't be on hook for as much rent in that month. So it can be advantageous for both parties. Next is a single net lease. In addition to X dollars per month, the landlord requires a tenant to pay either maintenance fees, property taxes, or insurance. A double net lease is when you pay two of these. Triple net lease, obviously, is when the tenant pays, X per month plus all maintenance expenses plus X dollars per month, like we said, plus building insurance, plus property taxes. So triple net lease is when the tenant's paying everything: maintenance, insurance, and property taxes. If it's multi-unit, it's allocated. Share is pro rata based on space leased in total building. If you're the tenant's lawyer, how could you counter a triple net lease language in order to protect your client? First you could just negotiate down to a double net lease, so you're paying less, or you could agree to an expense stop. And that is a cap on expenses tenant will pay in terms of maintenance. Or you could itemize expenses that belong to the tenant and landlord respectively. Next is a flex payment lease. So that's where you pay so much rent per acre, but if your tenant has certain production levels, then the excess rent may be split between landlord and tenant. So this is common for agricultural leases. Next, we'll talk about security deposits. Your lease should be carefully drafted to be neither a minimum nor maximum covers the damages of property. That's what you do if you're representing the landlord there. Security deposit is usually 1 month rent, but it can be changed based on tenant's financial risk. Specify the timeline for returning security deposit or assessing more damages. So what factor goes into determining the security deposit on a commercial lease? So one, you might have the size of the space. Two, you might say who's the tenant. So if you're a landlord and you're leasing to a large publicly traded company, you probably won't charge a security deposit. If you have a personal guarantee from maybe an owner of of an accounting firm or something, and that owner has deep pockets, maybe you have little to no security deposit. And non-securitized, you may increase the amount of rent that is charged if someone doesn't have a security deposit. That could be a trade-off you could bargain for. Covenant and continuous operations in the commercial lease. So the owner is going to want anti-going dark clause. A anti-going dark clause requires a business to continually operate. Landlords will want this because it drives foot traffic and other tenants. Like with malls, you want a bunch of stores that are open. Owners will especially want anti-going dark clause for several year-long lease. You don't want going dark is when the business closes up and it's like an empty vacant storefront. You don't want that if you're a landlord. Next, we'll talk about use restrictions. So why might an owner want use restrictions? They might want it to keep the market in an area from being oversaturated. They might have compatibility of use concern, and they might have exclusivity rights. Other restrictive covenants might be what other use restrictions might an owner want? There'd be no going out of business sale. This makes sense because it makes the whole business look like it's going out of business. Like it makes the whole strip mall or whole shopping center look like it's going out of business. So a landlord might want to have a restrictive covenant that says you can't have a going out of business sale, make it big and advertise like that. You might also want no noise and odors. Also might have a signature requirement. So the owner, landlord might want to maintain certain aesthetics. Next, we'll talk through expenses. So you're going to want to spell out common area expenses and how they're allocated to tenant. As a tenant, you want expenses allocated like this. You're going to want tenant area common area expenses to be the square foot of the tenant space divided by the total square footage of the building, because you're going to be less of a denominator. As an owner, you want expenses allocated as square footage of tenant space divided by the total leasable space in development. It's because the tenant wants a larger denominator here, so they'll have a smaller percentage of the expenses they're on the hook for. On the flip side, the landlord is going to want a smaller denominator, which puts each individual tenant on the hook for a larger portion of the space. Assignments and subleases. If you're the owner, you want language that assignment will not release original tenant if assignee does not pay the rent. If you're the tenant, you want obligations terminated once the assignment is approved. So a sublet, the tenant is not released, the original tenant is still on the hook for the subletter, and for an assignment, the tenant is means that the original tenant is released from having to pay obligations. Usually, that's what an assignment means. Damages. So we want liquidated damages clause for other parties if they breach the agreement. Makes sense. Relocation. Owner might want the right to relocate the tenant to another space because of either appearance or to maximize foot traffic or for occupancy concerns. Also, you might want an option to purchase leased properties. The tenant might want the right to purchase a leased property at the end of the lease.